Welcome to Nasdaq TradeTalks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining us at the MarketSite studio, we have Shana Sissel. She is the founder and CEO of Banrion Capital Management to discuss why advisors are increasingly looking towards private credit as a way to get high yield. Shana, it's great to have you with us. Welcome to Trade Talks.
Thanks so much for having me.
Certainly, private credit is one of the biggest trends right now. Why is now a favorable time for investors to get into private credit?
Private credit tends to be more favorable in environments where bank lending is tightening. And that is exactly what we're seeing with the banking crisis, the mini banking crises we've been experiencing since March. The credit markets and traditional lending have really seized up. So you have to go to other options, and private credit seems to be the place that makes the most sense, but that also means that there's more opportunity for investors to invest in the space because there's more people going to that space to find opportunities for credit.
Let's talk about some of the areas where people are looking. What about emerging markets and infrastructure?
So infrastructure, yes. I can't say I know a ton about the emerging market side of private credit because it's not really an area we play, but there's definitely quite a bit of interest in the infrastructure side. And that's very interesting because in terms of risk, you know, infrastructure tends to have hard assets behind it as a collateral. So you can get some really good returns and have a more favorable risk profile in infrastructure than some of the other areas of private credit.
What about commercial real estate? Because we know in commercial real estate,
Yes.
it depends where you invest. It's not all equal.
Very, very particular areas of commercial real estate. I think a lot of people have kind of said that commercial real estate is a place you want to stay away from, but I disagree to your point. There are very specific parts and pockets of commercial real estate that you definitely don't want to be in. Office space being one of probably the most obvious, but also traditional retail is another place I would stay away from. But things that fall into commercial real estate as well are things like self-storage, things like logistics operations centers, things of that nature are very interesting here, and it's an opportunity to kind of get in while people are kind of poo-pooing commercial real estate.
Let's talk about regulation for a moment here. Non-bank lenders, are they regulated? What does that look like?
They are not regulated like banks are, so there is additional risk here. I was actually talking to someone recently about this very fact, particularly when it comes to the more broadly available private credit opportunities that traditional investors can get into. We have interval funds now, closed-end opportunities, so the average investor can actually gain access to private credit, but you want to be really careful there. So you want to be able to work with someone who knows and understands the underlying opportunities so they can do the due diligence, because on the institutional side, they are much more particular about what they're investing in because they have teams of people that are experts in the space that do the due diligence on each individual deal. So they are much more particular. If it's gotten to the point where it's downstreamed that much, I just say proceed with caution. That's not to say that there aren't really great private credit opportunities for the average investor, but there is a plethora of a lot of things that just have downstreamed because there isn't a lot of institutional interest. And with the lack of technical expertise from a due diligence perspective, you just want to be careful.
So it sounds like you're recommending to advisors to go into private credit funds versus direct investing into private credit.
Correct. If you are going to do any sort of co-investing on the private credit side, you want to make sure you're working with a partner that has technical expertise in the space.
Does private credit tend to perform better in one market than the other, or are there opportunities regardless of the business cycle?
There are always opportunities, but this is the time where they tend to do better, when lending and traditional banking has tightened and there's more people coming to the private credit markets in order to gain access to credit. So there's more opportunities for individual investors since there's more deals being done. It tends to happen at times where the banking system is tight, as it is now. And it tends to be at times when we're kind of at a lull in the economic cycle. So distressed debt, in my opinion, also falls into that private credit, and distressed debt tends to do really well at the bottom of an economic cycle. So if you believe we're going to be in a recession, or you think we're heading that direction, this is definitely an area you want to be.
Traditionally, private investments are thought of as illiquid. For advisors, for retail investors, if you were to go in a private credit fund, is there liquidity like a mutual fund or an ETF as an example?
There is not.
Right.
And that is definitely something you need to be cognizant of. You need to make sure that your client or you as an investor are comfortable with the fact that there is not the kind of liquidity you would see in the traditional markets. Most people can gain access to private credit through interval funds right now, and interval funds do have some liquidity, but it is limited. So when you think about the situation that happened with BREIT, in that all of a sudden, oh my God, I can't get my money out. It's a similar structure in private credit, so you just want to go in with eyes wide open and understand that liquidity is going to be limited, so position size accordingly.
So it looks as if they're going for returns beyond the 60-40, right? And this is a way to supplement part of that return.
Yes, but I would say that private credit is still credit.
Right.
It is not a diversifier. So when you talk about alternatives or complements to a 60-40, you're talking about more like a liquid alt, which is a true diversifier, low to no correlation to traditional markets. Private credit's still credit. It's still highly correlated to credit markets. It's just less liquid. And because it's less liquid and not in a open market scenario, there's more opportunities to generate alpha because there's an information edge, but it is still credit. So it should be part of your fixed income portion, and that's where you should really be allocating it. Small position, make sure you're comfortable with the illiquidity.
All right, Shana, I appreciate the insight. Thanks for
Thank
joining
you.
us on Trade Talks. And thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.